the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements for today. Well, Singapore shares dipped as investors continue to mount new property cooling measures in the country. Now, the Straits Times Index was down 0.23% at 4,010 points at about 1:29 p.m. Singapore time, and that is with a value turnover of some 620 million Sing dollars seen in the broader market then. But let's take you through the closing numbers. The STI ended in the red as well, down 0.15%. We're looking at 4,013 points. In terms of value turnover, that's 1.1 billion Sing dollars. Now, gainers trailed losers, 192 versus 282. Top advances for today, we've got for you ASUS, DBS and HPL. And top decliners, we have here GMHUSD, ST Engineering and UOL. Now, it's all about SGX-listed property developers today, as the Singapore government raised the seller's stamp duty rates by 4 percentage points and extended the holding period that SSD applies from 3 to 4 years. And in the meantime, from how U.S. President Donald Trump's tax package cleared its final hurdle in Congress to how the president is planning to start sending letters to the U.S.'s trading partners to inform them of their tariff rates, we've got more international headlines in focus today. And joining me on the line is Benjamin Goh, Head of Research and Investor Education at SIAS. Ben, welcome back to the show.
Hey, hi, how are you?
Good, and so many things to watch as usual. So Let's start one by one. Starting with the Singapore stock market, we will talk about property developers in just a bit. But very quickly, how did the STI fare today? Any surprises when it comes down to the biggest movers, save for the property developers?
Well, the big caps didn't fare too well today. So you've got, household names like SIA Engineering, ST Engineering, Yang Zijiang, Shipbuilding, Keppel, all down by at least 1%. But obviously, the STI, most of the market cap is made up by the three local banks. Local banks closed up between 0.2%, 0.3% for UOB and OCBC. Performance was generally lackluster. DBS was up 0.5%, so it wasn't great. So it does look like the local market is taking a little bit of a breather this week after the positive trading, after the risk-on environment that's been happening in the U.S. I think that is not unexpected given that it's a Friday and U.S. markets are actually closed this evening because of the 4th of July holiday.
Okay, and Ben, let's take a look at Singapore. SGX-listed property developers in focus today as the Singapore government raised the seller's stamp duty or the SSD rates by 4 percentage points and extended the holding period that SSD applies from 3 to 4 years. Now, the measures are aimed at deterring flipping property for profit. How has the move influenced the price movements of counters such as Fraser's Property and UOL Group? Because I believe the measures are in effect now. UOL is launching Upper House at Orchard Boulevard soon. Fraser's Property and Sekisui House, they're previewing the Robertson Opus this weekend. So what's your take on the matter?
Well, the market obviously had a knee-jerk reaction, basically a broad-based sell-down of the entire property development sector, not just for UOL as well as Fraser. But I guess those two companies, in focus today, simply because they are launching new projects really soon. So specifically, UOL and Fraser closed down 2.1% and 0.56% respectively. I guess from an anecdotal perspective, UOL fared a lot worse compared to Fraser simply because it was trading at a higher PE ratio of 15 times versus Fraser's 13 times. So, this tends to happen. More expensive stocks get sold down more, in a market downturn. The other piece of information could be that the Upper House at Orchard Boulevard is a 99 years leasehold, while Robertson Opus is 999 years leasehold. I'm not a I guess, a property broker, so I don't really know whether it's a factor. But, if I'm buying a unit, this is something I'll probably look at. So the perception could be that a longer leasehold or freehold property retains more of its value. Not sure. I think what is clear is that we definitely need more specific, high-frequency data. So after launch day or come launch day and post-launch day, we want to see what the actual sales numbers are and whether developers actually have to throw in discounts or extra freebies to move units. So from a broad-based perspective, cooling measures definitely, or rather generally a negative for the property sector. And the timing could not come worse because it's, they just announced it as in fact, that's one. Two is, of course, the timing is bad, the current economic situation. So now the focus is still back on the, tariff war. Donald Trump threatening to send out letters. The U.S. Fed has not cut interest rates. Doesn't look like they're going to be doing that anytime soon, which means that Singapore banks also have got very limited leeway to reduce interest rates. And again, this week alone, if you look at the local mass media, quite a few newspaper articles about concerns about unemployment, not just for the fresh grads, but also for the labor force as a whole. So net, not a good look for property sector at this point in time.
I guess we still have to wait till the weekend to see whether people are still going to show flats, right?
Exactly. So, let's wait for that and see if they need to throw in free washing machines to move units. That's obviously not a good sign.
Okay. And another counter to watch for today, Ben, is Infotech Systems. Infotech Systems made its debut on the main board of the SGX, and I believe this is significant because this is the first listing in close to 2 years on the main board of the SGX. I believe second listing of the year, first one on the Catalyst this year. So shares of Infotech Systems were up 9.2% above the IPO price at the open. How do you assess Infotech's first day performance then?
I guess in a nutshell, not great. So yes, there was a nice pop from the IPO price to the opening price. And if you look at the price action, the first few minutes were great. So the price shot up, to a high of 98 cents. But since this morning, it slid from 98 cents to, I believe the closing price was 91 cents. So if you look at the business model for Infotech Systems, it's a pure HR and accounting software as a service play. So from that perspective, the business model could be good as a long-term investment simply because of the inherent stickiness of its captive market. There is a real switching cost for companies to move to other platforms. I mean, if you just think about it, if you want to move from Gmail to Microsoft, email, right? Or if you want to move from an Xbox to PlayStation, there is an inherent switching cost. And we're talking about big companies or rather, SMEs. So, from a business model perspective, that's great. So it's a good start. But, what we really want to see is to have more institutional investors coming in or to have some kind of positive catalyst to move the stock further. So this company is 17 years old. So it's, not a neophyte. But the thing is, move the stock further, we need better data on the upcoming sales forecast, profit, profitability, so on and so forth.
Okay. And then if we could stay in Singapore, Singapore's retail sales that grew 1.4% year-on-year in May on the back of higher motor vehicle sales. Now, the reading, though, was below the median estimate of 1.8% growth from private sector economists polled by Bloomberg. What do you make of the latest numbers? And if I may stretch that question a little, what are the implications on SGX-listed consumption-driven companies?
Well, as you mentioned earlier in this call, that the data is actually not great. So excluding motor vehicle sales, retail sales was about flat year on year. And if you throw in the seasonally adjusted monthly calculations, retail sales was actually down by 0.6% year on year. So not great. So from the data, it does suggest that Singaporeans are spending less on both eating out and on departmental store sales. And they're spending more on supermarkets, personal hygiene, and medical products. Now, if you think about supermarkets, if you go to Sheng Siong or NTUC FairPrice, that's very different from eating at Teng Lok restaurants, right? Which, by the way, Teng Lok restaurants was sold down quite a fair bit today. So it does suggest that Singapore consumers are becoming a little bit more conservative in their spending, and a little bit more concerned about what's been happening with the economics globally as well as the local situation. So the current market cycle may actually favor defensives and low beta stocks for now.
Okay. If you're just tuning in, we're in conversation with Benjamin Goh, Head of Research and Investor Education at SIAS. Well, Ben, in global news, U.S. President Donald Trump said that his administration will start sending out letters to trading partners on the 4th of July, be it tonight or overnight, setting unilateral tariff rates, which he said countries will have to begin paying on the 1st of August. I believe we're looking at a fairly wide range from 10 to 20%, all the way to 60 or 70%. How have investors in Asia digested the news, though?
Well, very much a mixed bag. So markets range from about flat to about negative 0.5%. I think most markets are adopting a wait-and-see approach, again, because it's the end of the week and U.S. markets are closed. But again, specific markets have got specific uncertainty. For example, in Japan, it's all about the price of rice, right? So we have shortage of rice, price escalation in rice. In Japan, the kind of doubling year to date. And of course, the news flow coming out is that the Japanese government is going to protect its local farmers to the detriment of its trade relations with the U.S. But we are not really seeing it in the performance of the Japanese market today. Again, more or less a wait-and-see approach. So I would say that the Asian markets are not making any big moves either way before the weekend. They're trying to finalize trade deals with the U.S. So what's been coming out of the U.S. is the announcement. I think is more of a pressure tactic to make sure that most Asian countries kind of sign on the dotted line sooner rather than later. So until we get more concrete information about the trade agreements, I think we should expect more volatility in Asian markets.
Okay, and we must talk more about Trump before we let you go, Ben, because his tax cut package cleared its final hurdle in the Congress as the Republican-controlled House of Representatives narrowly approved the massive bill and sent it to him to sign into law. I believe he's signing it overnight, 5 p.m. local time in the U.S. What would this mean for U.S. assets, namely bonds and also the U.S. dollar, given the ballooning debt in the country?
Well, I think the combination of the tax cut bill and the ongoing trade friction between the U.S. and the rest of its, major trading partners, that combination is actually not good. So, if you think away from a macro perspective, right? So if most countries end up trading less with the U.S., what that means is that most countries will have less need to hold U.S. dollar.
Yeah.
And of course, when you hold U.S. dollar, you're not going to put it into a savings account, right? So most countries are going to kind of buy U.S. government bonds. So if you are holding less U.S. dollar, then you're going to need to buy less U.S. government bonds. So from that perspective, there's going to be a less demand for both U.S. dollar as well as U.S. government bonds. So the tax cut package itself actually puts the U.S., as you mentioned, on a weaker fiscal footing. Eventually, global investors are going to demand higher yields on U.S. assets, and predominantly that's going to be U.S. bonds. Of course, U.S. stocks, you can get away with making them attractive by having high returns. Companies like NVIDIA, so on and so forth, they're still going to be, higher price performance. But for U.S. government bonds, U.S. corporate bonds, that could be a concern. Okay, so we are not going to expect the market to, fly off the cliff anytime soon. But I think the long-term prognosis for U.S. dollar and U.S. Treasuries is not going to be great. I think the only saving grace is, of course, taking a talking point of the Republicans is that the idea is that lower taxes may eventually spur higher consumption and higher investments, but that remains to be seen. So that actually happened when Reagan was president, but didn't quite happen in Trump's first administration.
Okay, I see. Lots to watch indeed, and thanks so much for the insights, Ben. That was Benjamin Goh, Head of Research and Investor Education at SIAS. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.